What are some indirect factors that may determine mortgage rates? Navigating the realm of mortgage rates involves understanding the intricate web of factors beyond the obvious. Beyond credit scores and loan amounts, indirect influences silently shape the landscape of home financing. In this exploration, we delve into the subtle yet impactful determinants, including inflation, economic growth, monetary policies, the bond market, and housing market conditions. Unraveling these complexities is crucial for anyone seeking a mortgage in today's dynamic financial environment. Inflation. Inflation is a critical factor influencing mortgage rates. When inflation rises, the purchasing power of a currency decreases, leading to higher prices for goods and services. Lenders anticipate this and adjust mortgage rates to compensate for the diminished value of money over time. Inflation erodes the real return on investment for lenders, prompting them to seek higher interest rates to maintain profitability. Mortgage rates tend to follow the trajectory of inflation, impacting the cost of borrowing for homebuyers. As inflation increases, lenders often respond by adjusting rates upward to protect their returns. Moreover, inflation affects the broader economy, influencing consumer spending, business investments, and overall economic stability. In an inflationary environment, central banks may implement monetary policies to control inflation rates, indirectly affecting mortgage rates. Investors closely monitor inflation indicators, and any signs of rising inflation can lead to increased speculation about potential rate hikes, causing lenders to adjust mortgage rates accordingly. Homebuyers should stay informed about inflation trends as they directly impact the affordability of homeownership. Economic growth. Economic growth plays a pivotal role in shaping mortgage rates. Lenders closely track the overall economic health of a country as it directly affects borrowers' ability to repay loans. During periods of robust economic growth, incomes tend to rise, unemployment rates decline, and consumer confidence strengthens. This positive economic environment often leads to higher demand for loans, including mortgages. To balance increased demand, lenders may raise interest rates, making borrowing more expensive and cooling down the economy. Conversely, during economic downturns, central banks might lower rates to stimulate borrowing and spending, making mortgages more affordable. Additionally, economic growth influences housing demand and supply. A growing economy can lead to increased housing demand, putting upward pressure on home prices. Higher home prices may result in lenders adjusting mortgage rates to reflect the changing dynamics of the real estate market. Understanding the relationship between economic growth and mortgage rates is essential for potential homebuyers, as it provides insights into the timing and affordability of entering the housing market. Monetary policy. Monetary policy, set by a country's central bank, significantly impacts mortgage rates. Central banks use tools like interest rates to regulate economic conditions. When central banks raise interest rates, it becomes more expensive for banks to borrow money, leading to higher borrowing costs for consumers, including those seeking mortgages. Conversely, when interest rates are lowered, borrowing becomes more affordable, stimulating economic activity. The relationship between monetary policy and mortgage rates is evident in the immediate market response to central bank announcements. Central banks also use monetary policy to control inflation. By adjusting interest rates, they aim to keep inflation within a target range. A proactive approach to managing inflation contributes to economic stability, influencing lenders' confidence in providing mortgages at relatively stable rates. Homebuyers should keep a close eye on central bank announcements and monetary policy shifts, as they can have a direct impact on the interest rates available in the mortgage market. The bond market. The bond market is a key determinant of mortgage rates. Mortgage rates often mirror the yields on long-term government bonds. When bond yields rise, lenders may increase mortgage rates to maintain profitability and attract investors. Conversely, falling bond yields may lead to lower mortgage rates. Investors view bonds as a safer investment than stocks, and as a result, they may shift their investments between the two based on market conditions. Changes in bond market dynamics can quickly influence mortgage rates, making it essential for potential homebuyers to understand the relationship between bond yields and mortgage rates. Furthermore, the bond market reflects investor sentiment about the economy. During periods of economic uncertainty, investors may flock to bonds as a safer haven, leading to lower yields. In contrast, a more optimistic economic outlook may prompt investors to shift from bonds to riskier assets, causing bond yields to rise. These fluctuations in the bond market directly impact the cost of borrowing for homebuyers, making it crucial to monitor bond market trends when considering a mortgage. Housing market conditions. The conditions of the housing market itself play a substantial role in determining mortgage rates. The relationship between supply and demand for homes, along with the overall health of the real estate market, can influence the cost of borrowing. In a seller's market with high demand and limited housing supply, home prices tend to rise. Lenders may adjust mortgage rates to reflect the increased risk associated with higher loan amounts. Conversely, in a buyer's market with more homes available than buyers, lenders may offer more competitive rates to attract borrowers. The health of the housing market is also influenced by factors such as foreclosure rates, housing starts, and regional economic conditions. High foreclosure rates can signal market instability, prompting lenders to be more cautious and potentially raise mortgage rates. On the other hand, a growing number of housing starts and a stable economic environment may lead to more favorable mortgage rates.